Today we're going to look at accrual accounting and adjusting entries. So what we look at is some different accounting methods. So the first thing that we see here is that cash basis. Now the cash basis is used by many small businesses, and it's based on when cash actually changes hands. When cash is received, revenue is recorded. Expenses are recognized when cash is paid. This method is not in conformity with generally accepted accounting principles, or GAAP, due to it can accelerate or delay revenues and expenses. Cash flow is used to measure the company's performance underneath the cash flow method. The method that we are going to go into more detail with today is the accrual basis of accounting. This method gives a more accurate picture of a company's current financial position. It is in conformity with US GAAP, and publicly traded companies are required to use the accrual basis of accounting. Accrual accounting is different from cash basis accounting in how and when revenue and expenses are recorded. Kitten states that accrual accounting measures the performance and position of a company by recognizing economic events regardless of when cash transactions occur. OpenStack states that revenue and expenses must be recorded in the accounting period in which they were earned or incurred, no matter when cash receipts or payments occur. Therefore, accrual accounting does not look at when cash changes hands. Accrual accounting better matches revenues and expenses and standardizes reporting for comparable purposes. Comparability is important to both internal and external users of financial statements because it leads to better decision making about investments, lending decisions, budgeting, as well as growth strategies. The concept of comparability is found in several accounting assumptions and principles. OpenStack discusses accounting periods in their definition. It states the time period assumption is taking the life of a company and dividing it into artificial time periods to report the financial data in a timely manner. A company can divide financial data into months, quarters, years. It really depends on the company's needs. The two principles look at in which period revenue and expenses should be recognized include the revenue recognition principle, which states that revenue should be recorded in the time period when it is earned. The matching or expense recognition principle states that expenses should be recorded in the time period in which they are incurred. Adjusting entries are the way that a company can ensure that the company is in conformity with GAAP assumptions and principles. They are used to update accounting records at the end of the period for any transactions that have not been recorded, to recognize income or expenses that occurred but are not accurately displayed on the company's records, and also to ensure that the income statement and balance sheet amounts are correct. Adjusting entries will have one balance sheet account and one income statement account. There are two different types of adjusting entries. The first type is the prepaid or deferrals. This is when cash changes hands before revenue or expenses are recognized. The other is the accruals. So accruals is when cash receipt or payment has not occurred yet. And looking at prepaids and deferrals, there are prepaid expenses and unearned revenue. With prepaid expenses, when cash is initially paid, the company will record it as an asset. As the expense is used, it needs to be recognized. The asset will be decreased and the expense will be increased. With unearned revenue, when cash is initially received, the company will record a liability. As the income is earned, it needs to be recognized. This will decrease the liability and increase the revenue. So we're going to look at one type of prepaid expense, and this is supplies. So in a previous lesson, we discussed when supplies are purchased, the supply account is debited, and as the supplies are used, they will need to be expensed. So we're going to take a look at an example. So here we have XYZ Corporation has a balance on December 31st of $10,000 in the supply account. A physical count shows that the balance on hand is actually $7,000, and we want to prepare an adjusting entry for December the 31st. So the things and questions we need to ask first is, well, how much was used? If the trial balance shows $10,000 and a physical count shows there's only $7,000, this means that $3,000 were used during the period. The next question we need to look at is what accounts are affected. So the supply account is one account that is going to be affected because the supply account needs to decrease by that $3,000. The other one would be the supply expense account because we have used these supplies and they are now an expense. Therefore, the journal entry would be supply expense would be the debit, supplies would be the credit for the $3,000. Another type of prepaid is insurance. We discussed in a previous lesson when insurance is purchased for more than 1 month, the prepaid insurance account is debited. As the insurance is used, it needs to be expensed. So we're going to look at an example. XYZ Corporation purchased an insurance policy for 1 year on June 1st for $12,000. And we want to prepare the adjusting journal entry for December the 31st. So what we need to know is how much should be expensed. And the way we figure this out is we look at how much time has expired. So if we're looking at June 1st through December 31st, that's going to be 7 months because we have June, July, August, September, October, November, and December. The next question is how much would we be using per month? Well, the total expense is $12,000. We would then need to divide that by the 12 months. And that means it's $1,000 per month. Therefore, the total used would be $7,000. The next question is what accounts are affected? So what accounts do you think that we would be using in this particular transaction? Well, we're definitely going to have to use that prepaid insurance because we need to decrease that account. And then the other account that we will use would be the insurance expense account because that account needs to increase because we have used that during the year. So our journal entry would be insurance expense as a debit for $7,000 and prepaid insurance as a credit for $7,000. Another item that we look at is depreciation. So when equipment is purchased, the equipment account is debited. The way that a company allocates the cost of its equipment over the time periods in which it is used is called depreciation. So now we can look at an example. So XYZ Corporation purchased equipment for $20,000 on November the 1st. The equipment has a monthly depreciation of $240, and they want us to prepare a journal entry for December the 31st. So we need to know how much should be expensed. Well, if we look at this, what we will see is that depreciation is $240 a month. 2 months have passed, November and December. So we need to take that 240, multiply it by 2, and we get $480. Next, we need to look at what accounts are affected here. And so we do have some new accounts that we're looking at. And those new accounts, we would have depreciation expense would be the expense account. And that's going to be the income statement account. Now remember, we have to have one balance sheet account and one income statement account. So if depreciation expense is our income statement account, our balance sheet account is going to be a new account called accumulated depreciation. This is a contra account to our equipment account, which means it'll have the opposite normal balance. The journal entry that we would see at this particular time would be depreciation expense as our debit and accumulated depreciation as our credit. Unearned revenue is the other type of prepaid or deferral account. So when we look at unearned revenue, we can have some examples such as a lawyer's retainer, if you have subscriptions to magazines, sports tickets would also be items because you buy season tickets, and then as you use those tickets, that revenue then would be earned, but it's not earned until you use them. So what we look at here is when money is received, an unearned revenue account is credited. This account is a liability. As the money is earned, it needs to be placed into a revenue account. And so we have an example. And the example is XYZ Corporation has a balance on December 31st of $10,000 in the unearned revenue account. $4,000 remains unearned at the end of the year. And so we need to prepare that adjusting entry. So as always, how much would the journal entry be? How much was actually earned? Well, we started with $10,000 and there's $4,000 in the account right now, or should be. That means that we've earned $6,000. The next question is, what accounts are affected? Well, we have unearned revenue because that is what we're looking at. So that's definitely going to be one of the accounts. And the other account that we would use would be fees earned or possibly even service revenue. And so what we will see in this particular item is that because our unearned revenue account, which is a liability account, is going to decrease, it will be our debit. The amount that was earned would be our revenue, which is our fees earned, and that is going to be our credit. The other type of adjusting entries that we look at are accruals. So with accruals, journal entries have not been prepared and the revenue and expenses have not been recognized yet. Some commonly accrued expenses include salary, interest, and utilities. Some commonly accrued revenue items that we see are interest and service revenue. The first example of an accrual that we're going to look at is salary expense. Our company pays employees each week. At the end of the year, the company has incurred 2 days worth of salary expense, Monday and Tuesday, because the year ends on that Tuesday. So what we see here, XYZ Corporation pays its employees at the end of the week. Normal payroll for a 5-day work week is $10,000. The year ends on Tuesday. So that's where we go back to, Monday, Tuesday. They're not going to be paid till next year, but it's been earned this year. So according to the matching principle, the expense must be recorded when it was incurred. Therefore, the 2 days worth of salary in December should be expensed in December. So how much should be expensed? Well, what we would do is we would look at the $10,000. It is a 5-day work week. So how much would they be making each day? And so if we take 10,000 divided by 5, that gives us $2,000 a day. We have 2 days because we have Monday and Tuesday. And so that total would be $4,000. Now, what accounts do you think would be affected? Well, the first count that you will see would be salary expense. The salary expense is going to be the debit. Now the salary is still due. We still have to pay it in the future. Therefore, this is going to be a payable. So the balance sheet account that we would use would be salary payable, and that would be our credit. And so our journal entry would be salary expense debit for $4,000, salary payable credit for $4,000. The next entry to look at is the interest expense. So with interest expense, we have this example. XYZ Corp has 12% note payable for $10,000 that was taken out on May 1st, and we need to prepare an adjusting journal entry for December 31st. So as always, first question, how much should be expensed? And we can break this into how many months and how much is it going to be for a month. So to do this, what we are going to look at is how many months. So we have May, June, July, August, September, October, November, December. That is going to be 8 months. And then we need to look at how much a month. Well, to figure out how much a month, what we have to do is we have to figure out what the interest would be for the year. So if we take that $10,000 and we divide that by 12%, or multiply that, by 12%, what that does is it's going to give you the annual interest expense. You would then take and divide that by 12, and what we would end up with would be $100 a month. The next question is, what accounts are affected? So it's for interest expense, so we know interest expense is going to be one of the accounts that would be being looked at here. This is a note payable, means that we are going to have to pay it, so that's why we know it's interest expense, because note payables go with that interest expense item. And we would also have an interest payable for this particular account. So what we see on December 31st, we have interest expense, debit $800, interest payable credit for $800. Another item we see in accruals is accrued revenue. And so we have our service revenue, our fees earned is the one that we would look at. And the example we have here is XYZ Corp performed a service for $5,000 on December the 28th. The company has not billed for this service, nor has the company been paid. And it wants us to prepare an adjusting entry for December the 31st. So when we go in and we look at this, this is going to be very similar to what we saw in the previous chapter when we were billing for a service but had not been paid for it yet. So in this case, someone owes us money, and when somebody owes us money, that's going to be an accounts receivable item. So the accounts that we would be looking at, the amount's $5,000, but the accounts that we are looking at are going to be our accounts receivable, and we'd also look at fees earned, and both of those are increasing. So accounts receivable would be your debit amount for $5,000, and fees earned would be your credit amount for $5,000. Another interest revenue, another revenue account that can be accrued is interest revenue. And so with this example, it's very similar to the other one we looked at, where XYZ Corporation has a 12% 90-day note receivable for $10,000 that was issued on November 1st. So you want to prepare an adjusting entry for December 31st. So how much has been earned? Well, first, how many months? We have November and December, so that's 2 months. How much do we have for every month? Well, if we take the $10,000, we multiply that by that 12%, we get our annual amount, we divide it by 12, and then we would get $100 per month. So we're looking at $200 is the total amount here. What accounts are affected? So this is a note receivable. Since it's a note receivable, that means that we are looking at interest being earned by us. And so the accounts that we would look at would be interest revenue and interest receivable, because we haven't received this money yet, so it will be coming to us in the future. So interest receivable and interest revenue would be the accounts. Interest receivable is increasing, interest revenue is increasing, so the receivable would be the debit and the revenue would be the credit. So in looking at all of this information in summary, as far as accrual accounting is concerned, accrual accounting is required to be in conformity with GAAP. In other words, if you are following generally accepted accounting principles, you have to use accrual accounting. Accrual accounting gives a more accurate picture of our current financial position because it makes sure that we match our expenses with the time period in which they happened, and our revenue also is in the time period in which it was earned. So it is a more accurate picture. Adjusting entries are necessary to ensure that the income statement and balance sheet do reflect the correct amounts. And so that is why you would have one income statement account, one balance sheet account whenever you are doing your adjusting entries, because you don't want your income to be understated or overstated. You don't want your assets to be understated or overstated. You don't want your liabilities to be overstated or understated. So it's very important that you do these journal entries to make sure that you are reporting your income and your balance sheet in the appropriate manner.